exactly. That's everything.
Oh, my slide doesn't show. It's the picture with the name, the name product, and then all the slide doesn't show. Sure, you're fired. Right?
Yeah, exactly.
Not my problem, no problem.
So, Prof, excuse me, Prof. So that one, the subordinated bonds, is like the junior one.
Yeah.
Okay.
Yeah. That's
Thank
the
you.
junior. Yeah. We'll start at 2:30. I feel more awake now because now it's 7:30 a.m. where I live. So now I'm up.
In the morning now.
Yeah.
Oh my god.
I slept well, but I was still a little asleep. Your body doesn't know.
So Professor,
You're not supposed to be working at 2 a.m., right?
yeah, exactly. Are you going to go back after 3 days?
No, we're staying next week for my family's coming.
Oh.
It's Thanksgiving week, so
Okay.
Yes,
we
yes.
don't teach and my son doesn't have school.
Ah,
So
okay.
we take it off and travel around a bit.
Also, it's a good experience maybe for Thanksgiving here in Italy.
Yes,
Not that good in
we're gonna eat pasta
US.
instead of turkey. This was the only graph that didn't show, right? No, I forgot.
Yeah.
Was
Yeah, it's
sleeping.
only.
And when you got the file, did you get the PDF or the PowerPoint?
PDF.
Ah, okay, I'll fix that. The PowerPoints are very large sometimes, with
Yeah.
the size, so they put it in PDF, but
Yeah.
if it doesn't print correctly,
It's strange that how it can be a problem.
yeah, it's the printing. Yeah. Okay, 2:30, let's start. Okay, getting the mic. So welcome back. Let's get back to our discussion about corporate finance. Just before we start, I was having lunch with Professor Salvi, and we were planning the the exam questions. So he asked me to provide some multiple choice questions, and what I'm also going to do is I'm going to give you some practice questions, okay, with solution, so you can practice, and then there'll be like the exam questions. So at some time, when is the exam? Do you know?
The 29 is a Monday.
This Monday.
No, 29.
Which day?
The 29.
Oh, the 29th.
Yes.
Okay. Yeah. Okay, I'll have the questions ready by this Monday. So. I have a bank of questions. So, I wouldn't have time to prepare everything this weekend, but I have questions ready. Okay, so yeah, I'm going to give you some practice questions with solutions. I have put my email there. Okay, if people have questions about anything, just feel free to email me. So this is the nice picture that I made that wasn't showing. One of the key characteristics of debt we were talking about is the difference in recovery rates. And as I explained to you earlier, in corporate finance, we believe that this is one of the main reasons why bank debt is different from bonds. Right from the perspective of the lender, you can see that the secured bank debt by far has the highest recovery rate. And the same day, I know I almost remembered everything there, but it was like I was talking to people here. It was still 3 a.m. for me, so I was half awake. But anyway, this is the picture. It comes from Moody's. So this is a sample of loans, right? That Moody's just gets a sample of loans that go bankrupt. And then depending on the lender, you can calculate the recovery rate. Okay, and it's clear that collateral matters, right? Because senior secured bonds have higher recovery rates than senior unsecured bonds. But just the fact that the loan is made by a bank also increases the recovery rate. Okay, and let me mention that this market here is very small. Okay, I mean you didn't see in the example, right? There was a Home Depot. I think Home Depot has a small number of secured bonds, if you look at the data, but it's typically a very small market. When bonds are secured, they are typically secured by assets as well. So it's a bond that is secured by a specific asset, just like collateral. It's called asset-backed loans, this market, but it's relatively small. Like the big categories are secure bank debt and senior unsecured bonds. That's the one we're focusing on. There is also a relatively important market for subordinated bonds that, and actually leverage buyouts is another, it's an important real world example of situation when companies issue junk bonds, or not junk. The better word is junior bonds or sub. Okay, so. But we're focusing mostly on the two most important types of bonds and of debt, which is bank debt and bonds. And we learned towards the end of the morning, we learned how recovery rates are related to yields, right? So bank debt is a way of lowering interest rates, where you give more control to the bank. And then we went to, I don't think I need to do this again. And then we started talking about leverage buyouts, which is our first case. Okay, so just to recap here, let me move right? So we learned the theories, right? The theoretical arguments about optimal capital structure that you had learned with Professor Salvi, and I showed you the quantitative version with the optimal leverage ratio at 30% that I like to use in my cases. And the credit rate, we talked about credit ratings, credit risk, debt structure, and then our goal now is to talk about some real-world examples of corporate financing choices, right? And the first one that we started, let me recap here. So M&A is a good laboratory. We're going to have two examples from M&A. The first one is leverage buyouts, right? Which, I know this is not really an M&A class. I just gave a very quick introduction to leverage buyouts. I don't know if you covered this before or not. The important feature for our class, you don't have to know in detail what a leverage buyout is. The important feature that I emphasize in these slides is that a leverage buyout is a situation in which typically companies issue a lot of debt because the target becomes private. So for example, Dell became private in 2013, so you can no longer issue equity. The whole point of the leverage buyout is to buy back all the shares and take the company private. Okay? So that's why leverage buyouts are, and then we went through the math here, the balance sheet, right? I think it's a good skill when you're doing corporate finance to try to think about balance sheets in market value. Okay, which is there's fewer numbers, right? But the numbers, relative to a real-world accounting balance sheet, but the numbers are meaningful because it allows you to calculate the impact of different corporate activities. So M&A is a big one because M&A, the changes in balance sheet that happen with M&A are probably unprecedented relative to other changes. But this tool is useful in other contexts as well, right? So we estimated the post-LBO capital structure of Dell, right? And the point is that leverage goes up a lot following a leverage buyout, right? So the company goes from having like a median leverage ratio in the case of Dell, right? And the other point I want to emphasize is that you're not going to find a lot of firms with very small leverage ratios, right? So as we mentioned in this class about the trade-off theory, 30% is the optimal capital structure, but it's also the capital structure of the median firm. So many companies are around that level. So in a leverage buyout, it's very common to see situations like this. Of course, if Dell is starting from zero leverage, then you have more room, right, to issue debt without making the company become over leveraged. But since you're already starting from 30%, by the time you do a leverage buyout, you are going to be clearly in the over-leveraged part of the curve. Okay? And the reason why I gave the 30% is because, otherwise how do we know, right? The 70, 30, 27 is, I think this gives some clear a more clear picture of what we mean by over leverage. Okay, you have too much debt relative to the optimal, but in the case of a leverage buyout, you don't have an option, right? You would like to move the company back to the optimal, but since you cannot issue equity, and you already used a lot of cash, right? Think about the situation here. Even Michael Dell, the owner of the company, took $750 million out of his bank account to invest in this deal, right? And the private equity fund is investing 1.4. Maybe they could raise more cash, maybe not. Maybe that's the entire amount of equity of cash that they could invest in the deal, so the rest has to come from a debt issue. Okay? So the way we think about capital structure in LBOs is that this increasing leverage that we observe in here is kind of an unintended consequence, right? It's not that the private equity fund wants to lever the company that much. It's that the private equity fund does not have the option, to finance this deal with more equity. And we're actually going to see an example next where they are actually investing more equity, and we're going to see why. Okay, so that's the setup. So now what we want to think about is, right? So you have an over-leveraged situation, okay, and that's why private equity financing is a very good laboratory to study financial decisions, because you are in a situation in which making decisions about payout and which type of debt to issue, etc., that becomes very important, right? If you are just a public company that is close to the optimal leverage ratio, you don't have a large investment to finance. Marginal changes in your financial decisions are probably not going to matter that much. You're almost like in a Modigliani and Miller world, where small changes don't matter. You should focus on your business, right? Dell should try to develop a new computer instead of wasting time thinking about corporate finance, right? But in a situation like that, then you really need to think about corporate finance. So we think of private equity funds as corporate finance specialists, really. And that's why it's very enlightening to study what private equity funds do in order to manage this high leverage problem. Okay? So how do private equity funds manage the high leverage problem? So I'm going to talk about three different ways that, and then in the next case we're going to talk about an additional idea. And of course, payout policy we haven't studied yet, but it's pretty obvious what they're going to do, right? So suppose that Dell is paying dividends. What should a private equity fund do after a leverage buyout? You're probably going to get this, huh?
Not pay dividends.
Yeah, cut to zero, right? You are over-levered. Everybody understand this? You are over-levered. You have to save money to pay interest. If you have extra cash, right? Let's go back here. Suppose that Dell produces extra cash flow. What should you do with it? Instead of paying dividends.
Pay interest.
Well, yeah, suppose you have extra. After paying the interest, you end up with extra cash flow.
Buy equity. Buy debt.
Buy debt, right? I mean, you are in an over-leveraged situation. Leverage is destroying value according to the trade-off theory. So why are you going to pay dividends? You might as well go to the debt market, buy back some debt, move the company back to the optimal leverage ratio. We're going to see that they actually do that. Private equity funds actually do that. Okay? And then, of course, the other idea, and LBOs are a great example of this, right? What we learned in the morning, right? They're going to issue debt, but there are different flavors of debt. What type of debt do you think private equity funds issue in a leverage buyout? Do they issue bonds or bank debt? We're all tired at the end of the class, right? So
Bank.
but bank, yeah, why?
They're in financial distress.
Yes, right? It's a very good example of that. Right? So one of the main drivers of the demand for bank debt is being close to financial distress. And that's what's happening in a leverage buyout. If you're 70% levered, you're over-levered, the financial distress is destroying value, right? Anything that the company can do to reduce the risk of financial distress is going to be good, right? So it's very clear in leverage buyouts that the PE funds issue bank debt. Oh, and I think you were talking about someone here, I think was you were talking about one of the determinants of having bank debt is being not listed, right? So, however, a company like Dell, you do have the choice, even after the leverage buyout, right? Despite the fact that you became private, you can still issue public bonds. So you know, actually Dell did have some outstanding bonds after the LBO, so it's a choice. The private equity fund is voluntarily choosing to use bank debt to finance an LBO. So I think it's one of the best examples, you know, real world examples of this theory that we talked about in the morning, you know, like it's really clear. And you're going to see the data here in the next example as well, that private equity funds like bank debt. Despite the fact that they have to give up control, you know, the reducing interest rate becomes very important when you're financing an LBO. Okay? So let's see some of the details here. Right? So the first one is that you know, they are going to be, typically you're going to see both banks and bonds, right? Because the private equity fund, the typical target of a private equity acquisition is a large, mature public firm in the US that tends to be financed with bonds, as we learned before, right? So companies prefer to issue bonds. But then you know, because in normal times, a large firm like Dell will probably issue bonds. But then once the LBO happens, the LBO will be financed mostly with bank, and then you're going to end up seeing both after the leverage buyout. Okay? So let me show you the data. This is nice because for Dell is actually a let me see if I can move the video here. So Dell is a good example because what happened in the case of Dell is that the company became public 2 to 3 years after the LBO because they acquired another public company called VMware, and because of that they had to report the data backwards. So you can actually see the data for Dell, the cash flow statement, the debt structure before and after the LBO. So we can almost have a window what happened. You know, in other cases we have to guess because private equity funds don't report what they do sometimes. So, you know, they don't have to report data once the company becomes private. So unless you ask them, you don't get the data. But in this case, we can actually see the data, which I think is going to give us a very clear picture of all these financing tricks that private equity funds do. Okay, so this is the debt structure of Dell prior to the leverage buyout, right? So you can clearly see that most of it is the bonds. Okay, consistent with the other examples, right? We learned this, you know, large public firms in the US at least, they are financed mostly in the bond market, right? So there is a little bit of revolving credit, but most of it is bonds. Okay? Post LBO, what's going to happen is you're going to see bank loans. So they'll raise the additional amount using banks and Microsoft. And if you do the math here, you'll see that it doesn't sum to 15. I'm going to talk about that in a second. Typically, private equity funds raise more bank debt than what is the minimum needed to finance the deal. Okay, but this is just for now. Just take this as an example that they are issuing mostly loans. So there is senior secured loan. There is an asset-backed loan. There is a senior secured credit line that we're going to talk about in a second. And then Microsoft actually invested in this deal. And you know, if you ask me, I had no idea why they thought this was a good investment. You know, the NPV of that should be zero, right, as we learned. But they lent $2 billion for Michael Dell and the private equity fund to complete this acquisition. So this is a subordinated loan with a higher interest rate. Okay, so that's how they raise the debt, and this data comes from, you know, standard data sources. This data you can get. So the private equity fund will report. So if you want to look at other examples of leverage buyout, you can typically get data on what kind of debt they issue. because they report that when they prepare the documents for investors, etc. It's the financial accounting data post LBO that sometimes is hard to get. So what researchers do in the US sometimes is they go and ask the private equity fund, please give me the data so we can write a paper and see what happened. But then, of course, there's a lot of concerns that they are massaging the data, right? So they want to look good, they give you nice data on the best deal, so the research has to be very careful to really extract valuable information, and the data is almost self-reported. And I know that in other countries, actually I don't know about Italy, but I think Italy has good data on private funds as well. I know that in the UK, in the United Kingdom, you can get data on private firms, good quality accounting data, so people have used it to study LBOs as well. But in the US, like I said, the data is harder to come by. So let's practice what we learned before, before the break with this case, right? So, we talked about that already, right? But let's do it again. Why did Dell choose to issue bank debt rather than only bonds? Right? Because of lowering the risk of financial distress through the interest rate, right? Because bank debt allows you to borrow at lower interest rates, right? So there is a trade-off, okay? You have to give up control, right? For an LBO, low interest rates are especially valuable because you have a higher, it can lower your risk of falling behind on payments, okay? And this is the slide about, if you're wondering, why did they issue more than $15 billion? There is the standard arguments are, first, the private equity fund can even do some restructuring, right? So on the margin, the bonds should have a higher interest rate than the bank debt. So what you can do is you can use the extra bank debt to refinance some of your high interest rate bonds. So they do that. And the other financing trick that is common is that the credit lines have an insurance role that we were talking about before. So the fact that you have a $2 billion credit line doesn't mean that you draw everything, right? You can save some dry powder, and if there is a future problem with the deal, the banks can use this credit line as a source of liquidity. Not banks, sorry. The private equity fund can use the credit line as a source of liquidity. And as I said before, we're going to see a case study from the COVID crisis that I think is a clear example of a situation in which credit lines were crucial for corporate finance. Okay, but more in this later. Hopefully I will have time for everything. So, like I said, this is very nice because now we have data, right? We have data on the post-LBO that structure. That's what I was talking about. You can see that now we have term loans, right? So those come from the LBO financing. Now it's there is general other borrowings that we don't know what it is, but you can clearly see that there is a much larger fraction of term loans in the debt structure of Dell, which we can understand using the theories we saw in the morning. And then the early repayment we were talking about, right? So if you have extra cash, what are you going to do with it? You're not going to pay dividends. Okay? If you have extra cash, what private equity funds tend to do is to reduce leverage. And it turns out that Dell was a very successful leverage buyout. So the cases are very interesting. If it was an M&A case, we would tell more stories about the Dell LBO. But many investors believe that they paid too little for the company, and that Michael Dell tricked the other shareholders. So, but anyway, it was a very successful deal, and if you look, actually it's here. Let's see what the data is. I'll show you the data on this one. So you can see that the company issued a lot of debt in 2014 to finance the LBO, but then it repaid significant. This is the cash flow statement for Dell. You can see that there is net debt repayment in 2015, and then there is a little bit of net debt repayment in 2016 as well. Okay, so what's happening is, you can think about this in terms of the trade-off model, right? So Dell was over-levered, and anything you can do to move the company back to optimal leverage is going to increase value on the margin, and this is what apparently was happening to Dell following the LBO. The private equity fund is using the excess cash flows to move the company back towards optimal capital structure. Okay? And then payout policy, right? You can see it here. The dividends, right? I mean, we're going to talk about repurchase as well. There is no stock left to repurchase after an LBO. So the fact that stock buybacks go to zero is mechanical, right? Because you already bought back everything. There's no shares left. But the dividend is not mechanical. You could pay, the private equity fund could pay a dividend to itself and to Michael Dell after the LBO. It's just that they choose not to. Okay? You can see that dividends go to zero. Right? If you look here, Dell was paying $650 million of dividends prior to the LBO, and then it goes to zero. That thing means zero. It doesn't mean missing. It went to zero. So there is no cash being spent on payout. Okay? Payout is a luxury. That's one of the key ideas we're going to talk about in our payout lecture, is that companies pay out cash when they have excess cash. When cash is tight, then it has better uses than paying out to investors. Okay? So that's the Dell example. I think it's very enlightening, because it kind of illustrates the usefulness of these arguments used in the real world, right? Just learn the trade-off. But you actually see it at work. I think is nice. And the bank and the role of bank debt, and you kind of see that. You see all of that in an LBO again, because the change in capital structure is very dramatic, right? That's why you can see it so clear. Any question on this? I hope it became more clear. And like I said, I mean, it's unfortunate that it's so short, right? Ideally, what you want to do with this case is give you some stuff to read and work on it. The case study in a very short, compressed class like that is not very feasible. So this is the other LBO that I have here as an example, and this one is interesting because it's going to allow us to talk about preferred equity, which we haven't talked about yet. So it's the leverage buyout of a company called ADT, which I'm sure if you didn't live in the US, you probably didn't hear. It's a security services. So they install like alarms in homes, in businesses, and then they can connect to the police. If someone enters your house, the alarm rings and the police come and stuff like that. So they are a security services business, both for individuals and business. It's one of the largest of these companies in the US. So what happened in this case is that in February 2016, ADT was acquired by one of the most famous private equity funds called Apollo Global. And this one was the largest LBO in 2016, but it was not as big as Dell. It was a slightly smaller deal. And it had a very high premium. So M&A premium are typically 25-30%. In this case, the premium was 56%. So the private equity fund paid a very high premium for ADT. And we're not studying the motivation, the valuation. This is a topic for another class. What we're focusing on here is the financing decision. Okay, so all of it is interesting, right? But we're focusing mostly on debt and equity issuance, which is our topic here. So I'm going to focus mostly on studying the capital structure and seeing what happened after the LBO. It's just another example that adds to the Dell case. Okay, so this is the data on the company's pre-LBO capital structure. So that's prior to the leverage buyout. ADT in this case had $5.4 billion of debt, and the market cap was $4.4 billion. Okay, so let me actually go here. Okay, so this is good practice. It's simple, but it's good to practice this. So how do we calculate the leverage ratio? Remember, because there is a very specific definition of leverage. You know, you probably saw in Antonio, there are many ways to measure leverage, but to use the trade-off model, you need a very specific definition of leverage, which is, right, we learned it before in the morning, right, debt divided by debt plus equity, and it's market equity. Do not use book, okay? So, right, if you go here, it's, oh, this one is all right. Right, you have $5.4 million of debt. Let's round it like this. Okay, so that's how you would compute leverage, right? What do you think? Does it look low?
No.
What do we compare it against? 30%, right? That's why the 30% number is useful. Again, I don't want, it's a little bit of an oversimplification, of course, right? I don't want to give the impression that all companies have the same optimal capital structure. But in my experience with data like this, having the 30% benchmark is very useful because it really shows you when the leverage seems to be going too high. Of course, we could look at credit ratings as well, which I'm going to look at it now. But there I didn't focus so much on credit rating. I'm going to show you the credit ratings in a second. And also in the next M&A case. Okay? But that leverage was relatively high. If you look at the debt structure, mostly bonds, right? Not surprising, that's what I told you. Large public firms in the US, they like bonds. They don't like bank debt, despite the fact that they can borrow at lower interest, and that's because of the control story, right? They don't like to give up control over their financing decision. So and then we're actually going to talk about interest rates explicitly in this case. So here you have some data on the yield to maturities of different bonds of different maturities for ADT prior to the LBO. I'll show you in a second how we use this data, but we're actually going to try to estimate what's the financing, what's the interest rate that they would pay in for different types of debt and also preferred equity. Okay? And then the payout, right? Companies usually do repurchase and dividends, and in the case of the ADT, they were actually repurchasing stock and they were paying dividends. You can see that they did cut repurchase significantly in 2015, but dividends were pretty stable and not a huge amount, but they were there. Okay? So this is the analysis. I also added the credit rating there. ADT had a credit rating of BB minus, okay? And relatively high leverage, which we computed there, right? That's about 55%, you can tell, right? And they were paying out dividends, they repurchased some stock. The average interest payment, that's how we're gonna take that table, we can calculate the average interest paid on the different bonds is about 5.2%. Okay? So that's what it looked like prior to the LBO. And again, we can use the trade-off model. The trade-off model is going to have some predictive power here, as you're going to see. It's going to help us understand how the private equity fund finances this. So one of the most, so just talking a little bit more about research, one of the biggest development in the last 10 years in corporate finance is, I think there is a lot more support for the trade-off model now than like 20 years ago. People were thinking that the trade-off model doesn't work, and now I think there is more evidence in favor of the trade-off model. So it's been a big change in the research side. And my experience, like I said, is the trade-off model does help explain, for example, private equity financing. Okay, so it looks like ADT was already over the optimal leverage ratio, right? If you're financing a leverage buyout, why is this a concern?
It's gonna grow.
You're going the wrong direction, right? you're gonna become, if you already started 50%, you're, okay? And we're gonna see that one of the things that the private equity fund is gonna do in this deal is actually they came up with a lot more cash to finance this deal. I'm gonna show you in a second. And my view is that's because the company was already over-levered, so the private equity fund did not, right? So the way to summarize, ADT was already in a tight financial situation. I didn't include here, but we could also do some cash forecasts. In an LBO model, we also like to forecast the cash flow statement and see how much cash the company is generating. The problem is ADT was already in a tight cash situation even before the LBO, so they didn't have a lot of cash to spare. Okay, so if you finance the LBO, right? Actually I gave you the answer to this already. But if you have to guess, right? What you would, right? I gave you part of the answer already, which is the large equity component. Okay, so we're going to see that they actually invested a lot more equity than in the Dell case, and then the other things are similar to Dell, right? So they're going to use bank debt, and they're going to cut the payout. So it's almost like a rule book, private equity financing. There is a bag of tricks that they always deploy, and really the reason they're doing this is to mitigate distress costs. Okay, so I think it's one of the best real-world evidence we have that financial distress costs do matter in practice, and sophisticated financiers like private equity investors care about it, right? And then we're going to talk about preferred equity, which is another trick, right, that we haven't talked about yet. In this case, there was $750 million in preferred equity. And it's, it doesn't matter who bought it, but it's an investment arm of Koch Industries. That's another fund in the US. So we'll talk about preferred equity in a second, but notice that in this case, remember, it was a $6.9 billion deal, and they were investing $3.6 billion in cash, right? Which is a very high fraction, right? Remember, in the Dell case, the fraction invested in cash was much smaller, right? Than in this case. In this case, they invested $3.6 billion, and I think the reason is because the company was already in a tight financial situation. And then, as standard with private equity financing, it's financed using bank debt. So here's a group of banks that participated in this deal. I'm not sure, I have the details on bank debt, and I'll talk about preferred equity in a second. So talking a little bit about the bank debt first. Again, you have a lot more than the minimum needed, okay? It doesn't mean that they have to use everything, right? And some of it may be used for refinancing purposes, as I said. So you can take your high interest rate bonds and buy them back, for example. Okay, but it's a lot more than the minimum needed, to finance this deal. Okay, so now what we can try to do is, we can make good use of our little credit risk model. If you remember that, that's probably going to be the most complicated thing we're going to do with math. I don't know. You guys are probably comfortable with math, but this is going to be a good example of how we can use it in a real world case. Okay, so again, we have the default risk, right? Similar to what we've done before. We can use the probability of default to estimate the expected return on the debt, right? So remember, we had the 5.2%. That was the average interest rate on the bond. So we're doing this for the bond. This is prior to the leverage buyout. Okay, so this is for the bonds. If you do that calculation, the weighted average, right? And using the probability of default for BB bonds, you're going to get an expected return of 3.8%. Okay, so that's what the investors were demanding in terms of expected return to invest in the bonds of ADT, right? And what we can do, right? We learned how to do this, and what we can do is we can use this credit risk model to estimate how much interest the private equity will save by using bank debt. Okay, remember what I said. This is a simplistic credit risk model. Okay, if you're working on a fixed income division of investment bank, you're going to be using more complicated stuff. But this gives you an idea of how people how they do it. Okay, how you go about estimating. Of course, the bank is going to ask you for an interest, but you can have an idea beforehand of what a fair compensation would be, right? So the main difference. The main difference, as we learned, is that the bank debt is going to have a higher recovery rate, right? So if ADT defaults and you have bank debt, then the negative return is only minus 20 rather than minus 60. Okay, that's how we're modeling it. And if you do the math, same exercise we've done before, right? To get an expected return of 3.8%, which is the same as the bond, you only need an interest rate of 4.12%. Okay? So on the margin, what this calculation is suggesting is that the private equity fund can reduce interest by almost 1% by using bank instead of bonds because the company is so highly levered, right? And that's another example of how bank debt helps reduce interest. Okay? Like I said, you can do this calculation algebraically in the paper, manipulating the equation. I like to do it in Excel because I always make mistakes when I do it. So I just put it in Excel. I actually have an Excel spreadsheet. If people want, I can share it. It's like 4 lines. It's not like serious programming, but you can you do a little spreadsheet to do this calculation. Okay, that's how I do it. But it's not high level math, right? If this was a real credit risk model, it would be a lot more complicated. Okay, so everybody understand this, right? So you can see that using real world data and the procedure we learned, you can get a significant savings, right, in terms of interest rate by using bank debt. Okay? And the reason why this is useful is because of financial distress. It's reducing the risk of financial distress because you're more likely, right, for the same profitability, you're more likely to be able to make the payment, right, than if you're issuing bonds, and the bonds are going to have a much higher interest rate. Okay? Questions on this? So now let's talk about preferred equity, right? That's like a picture of a note. This was issued in 1919. Yeah, this is like a historical thing. So why is the, have you learned about preferred equity before or not? Yeah? Okay. So why is the price, well, I just have this answer here, right? So here is why we finance academics believe that preferred equity is useful in leverage buyouts. Okay? So the key characteristics of private equity are that it's almost like debt. Right? It's really very close to issuing debt because preferred equity, it doesn't really pay a residual dividend, right? So what a preferred equity investor gets is a fixed fraction of the investment. So for example, if you land $750 million in preferred equity, you're going to get an interest payment, maybe like 10% a year. And then the company will pay you 10% a year. You will pay $7.5 million every year. It's called a dividend, okay, but it's really more like interest. One reason why it's called dividend is because this is not tax deductible, okay? So you don't get the same tax benefit that you get in the trade-off model, right? The benefit, the interest reduces taxes. Preferred equity is not tax deductible, at least in the US, okay? So I know that in Brazil, for example, where I'm from, there is a type of equity that companies can deduct from taxes, and it has a name there. I don't know about other countries, but in the U.S., preferred equity is not tax deductible. That's not the reason why you would never issue preferred equity, for tax reasons. Okay, and it's junior to bonds. So you preferred equity is only gonna get paid if the bonds get paid. So it's junior to any bond. Okay, that's why it's called equity. That's another reason why it's called equity, is that it's junior to bond, but it is preferred relative to common equity. So the way it works in practice is the company cannot pay a common dividend unless the preferred dividend is paid first. Okay, so for example, ADT, if the preferred dividend is $70 million, then unless they pay $70 million in preferred equity, they cannot pay a dividend. Okay, so they have preference over dividends. But that's not the main reason why preferred equity is useful for leverage buyout. The main reason is coming now. Okay, the key aspect of preferred equity is that this interest cannot really cause default. Okay, so you can always postpone the payment of the preferred interest. So if the company does not have cash, you can tell your investors that you don't have cash, and the payment gets postponed into the future. Right? What happens if you do that to the bank then? And the bank is gonna say, no, right? No, that's default. Okay, and we're gonna have to sit down and renegotiate. Right? If the company issues preferred equity, then they can always tell investors that they can't pay, and then it gets postponed, right? And so why is this useful when a company is close to financial distress? Right? It's really, it significantly reduces the marginal probability of financial distress, right? It gives the company financial flexibility, and that's the reason why private equity funds like to use private equity, preferred equity, to finance highly levered deals like this. Okay? And, right, one downside of preferred equity is that you're going to have to pay a very high interest. Right? Think about this. This is a security that is junior, right? So the recovery rate, thinking about our picture didn't have recovery rate on preferred equity, but we kind of know that it should be close to zero, right? If a company goes bankrupt, all the debt holders have to be paid first. So the preferred equity can only get recovery if the debt holders are getting 100% recovery. Otherwise, it's going to be wiped out, right? So preferred equity has recovery rate that is, we can take it as zero, right? So we can again use our simple credit risk model, right? I hope you find it interesting enough to practice a bit. Oh, you have to do the exam, of course. So there's going to be some calculation like that in the exam, right? We can use our credit risk model to estimate what the interest rate should be, right? And using the same data, okay? And this is even more of a simplification, because preferred equity there's more than two, right? So here I'm assuming that there's two states of the world. You either get paid the dividend or you get paid zero. But of course, there is postponement. There is, you might postpone the payment to a future. So modeling, doing a financial contingent modeling of preferred equity is a bit more complicated, but we can at least get an idea here. This is almost like a lower bound on what the interest should be, because I'm assuming that in the good state they get paid the entire return. Okay, so but if you do the calculation, you can see that the preferred equity dividend, to make it worthwhile for investors, right, it has to be almost 2% higher than the bond. And like I said, this is a lower bound, right? Because we are assuming that it's the same expected return, and the expected return could also be going up with risk. And we are assuming that you're always getting paid. If the company does not default, you get 100%. In practice, the investors the company has the flexibility to postpone the preferred equity payment. Okay? But you can see that there is a significant effect on the interest rate. Okay, and I hope I did all the math wrong. I probably did, because I did it in Excel. So the math should be right. Okay, you understand this? Any question on this? The numbers, I think it's more important to understand why you use preferred equity rather than knowing how to do this calculation. But I think the calculations are useful to illustrate what the trade-off is, right? It's not free to issue preferred equity and get flexibility. You have to pay for the flexibility, right? It costs you money. Any question? Right? So yeah, that's what I was talking about before. It's significantly higher, right? Because but it gives financial flexibility, and this notion of financial flexibility really it's the key here. Okay. Oh, I was going to ask you in the beginning, and then I forgot. So Nicholas was the suggestion is that we just going to have 2 hours, right? He suggested we just do it the 2 hours directly, maybe stop a little bit earlier, or we can take a break. Break? Okay. So you overruled. Yeah. Let's just finish this and then we'll take a break. The LPO slide is almost over. Okay. And then we go until 4:30. I still have my watch in the last time. Okay. Right, so what did we learn? I think, I hope you agree with me that LBO is a very useful lab. Right? We just saw a bunch of cool things happening. I mean, if you like corporate finance like me, I think it's cool. Interesting, let's say, at least interesting things happening, right? Because of over leverage, minimize the cost of distress. We see bank debt, we see early repayment, we see cuts in payout, we see preferred equity, and we also see subordinated debt. I kind of skipped that. I don't think we would have time. If people have interest in understanding why they like to use subordinated debt, we can talk about it in the break. Okay, but I skipped that. Okay. And so we can do the break now. We'll do start the other mini days after the break. Let's do 10 minutes. Yeah. Okay, 10-minute break. Those are the two rates that we use in credit rating. Right? And then what happens is the company, two companies, right? They have the same leverage rate. One has more profit. Then the company has less credit rate. Right? So you have higher credit. So I like to use this. I focus more on this. And I do some trade-off. That's one of the key variables that is going to learn where you are. Well, we're actually going to use this when we talk about that's the truth that I want.
vengono perquisiti e vengono tutti questi nuovi degni. Però prendiamo gli atti normali di prima, di Bell, più la seconda casa che abbiamo fatto erano meno, cioè era più pagata con le acquisizioni nuovi e quindi per quello il risultato c'è torniamo a casa sicure, no?
Non so se
Bisogna andare a casa.
fai studiare dopo. Fai andare a studiare.
No, perché ho stare con gli amici. Ah, vabbè, io andavo spesso all'opera, che è uguale. Ti accompagni, cioè sei in strada, nella strada e ci penso anche io. Sì.
Si spiegava io ero così, ma infatti lo sono vivo. Vabbè, dalla prossima slide. Anche per quello che ho dato.
Diresti che la stessa persona.
No, lasciamo grazie.
Ci siamo poco, viene sì. 这样我就很不合算了。我是27.42的话，这样我不就不往上涨了吗？
No。
那你也不能给我归到27吧？我操，这样就很尴尬。
我都不知道我算出来是多少。27也很高了，我觉得很高了。
我们哪怕那个不拿92.5，就他妈涨1分到2分，我都可以再升到28的呀。
但是你想想27哎，30分27，够了。
我们那个92.5太低了。
确实，就是那个把你的分儿拉下去。但是我觉得27已经算是很高的分数。
是27.42，差了0.08，就没有办法往上进，这谁都接受不了，我觉得。
太可惜了，感觉。
对啊。这样就很恶心啊！这个样子，妈的。
我知道。
我们是拿了92.5，我记得。哪怕93%也行，给我们92.5干鸡毛呀！
啊。
Ma dove sei andata? Siamo troppo motivati. Questi 10 secondi. Mia, ti piace il rischio per te da quello lì così, quello? No, vabbè, dai, guarda. Lascia binari.
宝贝，能借一下你计算器不？算一下分数。
好气！我操！
这个咋算？就是先算出来100的平均。
应该是先算出，对你按照100的那个算，最后再折到30%。
好。
Okay, should we get started? Okay, so now we're going to talk about equity issues, right? So the first mini case was mostly about debt issuance and different types of debt and the role of bank debt when leverage is high and etc. in LBOs. So the focus of this of these notes, these mini cases, is to show you some cases of when do companies issue equity. And the reason I call it when is because issuing equity, you can think of it as an exception to the rule, right? So as we discussed it in the morning, companies in the US typically do not issue common equity to finance investments. Okay? So they don't sell shares to raise capital to finance investments because of the negative stock price reaction. So we're going to talk about exceptions, right? When is it that we actually do observe company issuing equity. So M&A, turns out that mergers and acquisitions again is going to be an important example. And then we're going to talk about why M&A is a setting in which companies issue equity. Then we're going to talk about when is it that companies do secondary equity offering. So a secondary equity offering is when a public firm, that is a firm that is already public, sells shares in the market. And then this is in lecture 3 actually, because I don't have a lot of examples. It's mostly a short introduction to venture capital. We're going to talk about venture capital and why is it that venture capital issue equity. And here it's interesting that venture capitalists are going to use a specific type of equity that is not just common equity, and we'll talk about why, and then we'll talk about IPOs, which is the first time that a private company issues public equity. Then of course that's another instance in which we observe equity issuance. Okay? But as I said, you should think of these as exceptions. So, and the reason why M&A is an exception is something that we actually already saw. Is because merger and acquisition deals, and it's true for leverage buyout, it's probably the best example, but even other large M&A deals can cause significant changes in capital structure. Okay? And when a company finances an M&A deal, right, if you're going to pay for the deal in cash, then the cash has to come from debt issuance, right? And then the problem is a large debt issuance may not be optimal, right? Sometimes it may not even be feasible if the company cannot raise the debt. But in other cases, it's feasible, but it's not optimal, right? So it might be better for the company to, to issue equity and, and take the risk that the stock price is going to decline rather than having a leverage ratio that is too high. Okay? So that's the M&A setting. Again, I'm going to do this with a example. Okay, this is an M&A deal in the, those logos look the same. That's an M&A deal in the telecommunications industry in the US. DirecTV is a satellite provider of television, mostly also internet, but that business was not very large. And AT&T is one of the major telecommunications company in the US. So, it's my cell phone provider, for example. So this is AT&T is one of the major players in the telecommunications industry. And they bought DirecTV because they were diversifying into the satellite television. It turns out that this deal was a major failure, by the way, so it did not work. But I said this is not an M&A class, right? It's a class, we're just focused on the financing aspect here. But if you read about this deal, you will learn that AT&T was heavily criticized for having embarked in this deal when it happened. And of course afterward, right, when the deal didn't work, in the beginning it wasn't clear, investors were unsure, but the deal ended up happening anyway, and it turns out that it did not work out for the company. I believe that they are splitting, they split off DirecTV already from the main business. They are trying to focus now on wireless phone, which is their major growth business. So this deal was completed in July 2015. It was announced in May 2014. And the reason I have the announcement date there is because we're going to look at pre-M&A data. And as we mentioned earlier in the morning, to figure out what are the values of the companies, etc., prior to M&A, we have to look at a date before the market learned about the M&A. Because once the market learns, then the information about the deal is already going to be incorporated into value. So it would not be it's not the appropriate way to do the financial analysis. if you're the CFO of AT&T, for example, you're thinking about capital structure decisions, etc., using the pre-deal data. You have to do this before you announce the deal to the market, of course. If you're a decent financial manager, right? So that's why I have May 2014 here, and as a benchmark. At that time, DirecTV was $39 billion, right? The market capitalization. AT&T was 180. So you can see that the acquisition of DirecTV is a major investment for AT&T, right? So that's what I was talking about in the morning. I mean, you couldn't think of another situation in which AT&T would be making a $39 billion plus, right? There's going to be a premium. So it's going to be 50 billion almost, right? So there's no other instance in corporate finance in which a company is going to be investing 25% of its market cap in a single investment. M&A is the only example. And that's why M&A is interesting as well to study in the context of financing decisions. Okay? So premium, right? Like I said earlier, premium are 20 to 30%. So we're looking at a price of like $50 billion, right? 48 billion if you do it, at least 48 billion. Okay? And the DirecTV also has leverage, right? So when you buy, as we did with Bell in the LBO, you're acquiring the DirecTV, you acquire the debt as well. You have to become responsible for the debt. So DirecTV had about $20 billion in debt prior to the deal. You can see that is also close to 30%, by the way, right? Both AT&T and DirecTV were close to 30% leverage prior to the deal. So 30% is a useful benchmark, at least in the US. And that's what I was talking about, right? When you acquire a business, you become responsible for the debt of the target. So you can repay it at the time of the acquisition, or you can assume the debt and pay it later, and it becomes AT&T debt, right? But the acquirer also gets the cash balance, right? So really, the way we do this in M&A is we typically assume that, or we in our calculations we assume that the acquirer assumes. Well, there's too much assumes here, but yeah, that's so we suppose that the acquirer assumes the target's net debt. So net debt is the difference between debt and cash, right? So you have to pay the 20 billion, but DirecTV has 4 billion, so you could use the 4 billion to buy back some of the debt, for instance. Okay? So the net burden of the existing debt is 16 billion. But then, of course, there's going to be, the big ticket is not the existing debt. The big ticket is the offer, right? You're going to have to come up with $48 billion, right? So, plus if you add the 16, you have a $64 billion investment to finance, right? That's major. It's 1/3 of the company's market capitalization, right? Financing this major investment is not going to be trivial. So here you have some data on the balance sheet. Again, this is prior to the acquisition. Okay, so you can use this to. I think I'm using this to get the long-term debt. You also have income and cash flow statements for AT&T that we're going to use to look at some of the changes. But really, I remember what I want to focus on. I want to focus on cash. Okay, so AT&T has prior to the deal, of course, the company might be lucky and have $100 billion of cash lying around, and then you can use that to finance the deal. But as we're going to talk about when we study payout, public companies in the US, they typically don't accumulate cash like that. Accumulating cash like this leads to problems. So what companies do is when they generate a lot of cash, they end up paying it out to investors to avoid wasting the cash. That's something we're going to talk about when we study payout. Okay? So AT&T at that time of the acquisition had $8 billion in cash, right? So that's not nearly enough to finance, the $50 billion price they have to pay for DirecTV. So they have to raise cash somewhere, right? So what I want to do here, just to show you where the equity issuance comes from, is the way to think about this is we're trying to place ourselves in the pretend that we are the CFO of AT&T at that time, okay? And we have to raise $48 billion to complete this acquisition, okay? And we're going to pretend, right? So the CFO is probably doing some scenario analysis at this point, right? You can model the acquisition, they work with financial models, right? So the CFO is probably doing some financial models to figure out what happens under different situations, okay? So we're going to start by assuming, so we're going to consider a scenario in which you're going to finance the investment only by issuing debt, okay? And then see what happens. And I think that will show us why the company chose to issue equity, which is in the end, AT&T is going to issue equity, and we're going to learn one of the reasons why it was beneficial. So, so I got that data from the total debt I got from the balance sheet that I have in the slides. So AT&T had $83 billion in total debt prior to the acquisition. So if we compute current leverage using our formula, again, 30%, as I said, this is a useful benchmark. Many cases you look at for firms that are not too different, you're going to end up finding a capital structure that's about 30%. Okay, because that is what the research suggests. It should be close to the optimum. Many companies have capital structures around that value. Okay. So AT&T is already at the optimal capital structure, and right, any debt issuance on top of that is going to cause leverage to increase, right? So like I mentioned, let's think about this scenario analysis, right? The CFO is modeling the impact of the acquisition, and the CFO is considering whether he or she should issue debt, okay? And the new debt, right? If you issue debt to finance the acquisition, so we calculated, DirecTV. You have to assume the debt of DirecTV. You have to issue debt to pay the price. Plus, you have your own debt, so you would end up with $147 billion. Okay, so calculating the new debt is relatively easy. The CFO is going to have a little bit more trouble estimating the market value of the equity, because here is a little bit of a circular, because the market value of the equity depends on how the market will react to the deal, right? That's what I'm going to show you in a second, but you can understand the intuition. If the market reacts positively to the deal, then the market value of the equity is going to go up. If the market doesn't like the deal, the market value of the equity is going to go down. But the CFO doesn't know, right? Because you're modeling this before you announce the acquisition. Okay, so you're going to have to make an assumption here about what happens, and then work with that, right? But that's basically what's going to happen. So merger, really what happens in a merger when two companies merge, this is different from the leverage buyout, because the leverage buyout is the acquisition of a single target by an investment company, right? This is a situation in which two companies are merging. And, merging really is like adding up. And with the exception of, you hope that there is some value created that we're going to talk about in a second. But in principle, mergers is like adding up. So, we have our balance sheet in market value, right? That I told you, I think is one of the useful tricks to have in corporate finance, right? Is to have that simple balance sheet in market values. And we have AT&T, DirecTV, right? Plus the new debt, right? This is coming from the new debt here is coming from the M&A deal, right? So you're buying the assets of you're issuing debt to finance the merger, okay? So what's going to happen is you're going to have, we calculated this number, right? So if you just add up, right? If you do like a mechanic, if you just add everything up, with no change in value, right? What's going to happen is the equity is going to be the same. Okay, so you basically merged the two forms and you didn't add any value, right? Of course, what's going to happen in practice is that you hope that the deal is going to create value. You know, if you're the CFO of AT&T, you probably have some assumption. You know, you wouldn't be doing this deal, right? If you're just adding a DDAC-TV and not adding any value, okay? So you hope that this deal is going to create net present value for you, right? So the net present value of the deal in the balance sheet accounting is going to increase the market value of assets here, right? So for example, right? Suppose that this merger increases the profits of the combined companies. That was called synergies, right, in M&A. So the net present value of the synergies is going to add to the value of the company, right? But, you know, you don't know, right? If there is an NPV, then the equity will increase, right? But the empirical evidence that we have on M&A would probably give the CFO some cause to, the CFO should be pretty conservative when doing the financial analysis because, as we discussed it, you don't know how the market is going to react, right? You have your own assumptions, but the market has its own calculation, right? And what the CFO can look at, hopefully the CFO went to business school and heard about the empirical evidence. So the empirical evidence shows that on average, the acquired stock price does not change when an M&A deal is announced. So acquirers on average do not gain value when an M&A deal is announced. All the value gain goes to the target. Okay? So like I said, we're gonna check. In this case, we do have the data. I'll show you what happened. But the CFO here would be well advised to make a conservative assumption. And the conservative assumption might be maybe not too conservative because you might even want to consider the possibility that the stock price goes down. Okay? But a relatively conservative assumption is that the price does not change with the merger. So you have zero reaction. Okay? You're not creating any value, but at least you're not losing anything. So it's like a zero NPV assumption. Okay? Right, in that case, right, the market equity doesn't change as we argued before. Okay? So the post-deal leverage now is going to 45%. Okay? So that's in the all-cash scenario, your leverage is going from 30 to 45%. Okay? So everybody understands that this is like this is a what-if scenario. It's a fictitious. It's not what actually happened. I'll show you what happened in a second. We're doing this as a thought exercise to learn why companies end up issuing equity. Okay? But now we can use what we learned, right? We have the trade-off theory, and we know how credit ratings might change with this changing leverage, and we can use our tools to try to think about the decision of the CFO, right? So this is the picture with the trade-off theory, with the 30% benchmark, right? That we talked about in the morning. If AT&T is like the median firm, which, based on the existing leverage ratio, it looks like the AT&T should be close to a 30% optimal leverage ratio. What will happen is that following the M&A deal, the leverage is going to become high, right? It's not as high as in a leverage buyout, but it's still very likely to be higher than optimal, okay? So again, the trade-off model is telling you that financing this deal only with cash is going to if there's a problem, right, you might destroy some value because your capital structure is becoming over-leveraged, okay? Right, everybody understood it so far? Is it clear how I did this analysis? Right, again, this is the 45% is based on what the CFO is assuming about the market reaction. So this assumes a zero, right? If the CFO is very optimistic, of course, the market is going to love this and our price is going to double, then of course the leverage is going to be low, even if you issue debt. But that would be unwise, right? To make a very a very optimistic assumption. It's better to do this analysis or using a conservative setting, right? So of course, AT&T may have more debt capacity than the average firm, right? It's a large firm, it's very profitable, right? But here is an issue, as we mentioned in the morning session. CFOs in the real world also target credit ratings. The credit rating is an important metric in financial markets, right? And CFOs like to target credit ratings as well. So if we highlight here the leverage ratios that are typical of different ratings, right? So AT&T was at a BBB plus credit rating prior to, I'll show you the data in a second, but AT&T was basically here at the median leverage ratio. It had a rating of BBB, right? If they had financed this deal only with cash, they are moving into the BB range, okay? And as we mentioned in the morning, that's a jump, right? You're moving from investment grade to a junk rating, which is the jump that financial managers don't like. Okay, you want to try to keep your investment grade rating. So, in this case, they would be risking a downgrade to junk territory if they finance this deal only with debt. Okay, so the rating would be lower than BBB, and then what? So, and that's part of the reason. There are other arguments in MMA for why companies issue equity, but one of the main ones is that it is a way to manage leverage. Okay, so if you look at the actual financing of the deal, AT&T decided to issue equity as well. Okay, rather than paying everything in cash. So what AT&T did is it paid $14.4 billion. This is the total amount. It paid $14.4 billion in cash to the shareholders of DirecTV, but it also issued almost 1 billion new shares to finance this. Okay, so the way that M&A works is each shareholder of the target of DirecTV then will get, if you divide this number here by the shares outstanding, right? What you get is that each shareholder of DirecTV is going to receive $28.5 in cash, okay? And then you're going to receive shares of the acquirer. So AT&T issues shares and gives it to the shareholders of DirecTV in exchange for the shares of DirecTV. So you're basically paying by issuing stock, okay? You understand this? Any questions on this? Right, so you're paying by issuing stock, and this is what actually happened. Okay, and like I said, this is one you can understand this as a way to manage leverage. I think. So here's some data on the credit ratings. Turns out that with the actual financing, right? So you can see here that AT&T ended up paying for the deal mostly by issuing equity, right? Because the value of the stock payment is significantly higher than the value of the cash payment. So in the end, the credit rating of the company didn't change. Okay, issuing equity may have problems, as we're going to see in a second, but it helps maintain your credit rating because it's a way to manage leverage. So the major rating that companies focus on is the local currency long-term rating, but companies typically have a rating to issue bonds in foreign currency as well. AT&T doesn't use it that much, but yeah, you can see that it's the same rating anyway. But what this table is showing is that the rating of the company's debt did not change after the M&A deal was complete. Okay, so AT&T was successful in maintaining its credit rating. Of course, now I promise we're going to look at what happened to the stock price, right? And here I highlighted in this graph, I highlighted the announcement date. Okay, so this graph has the stock prices for AT&T around the announcement date, and also the volume. So I like to, the volume are this bar, the volume of trading, and when you're doing M&A analysis or really with any corporate event, it's a good idea to get the data on volume, because that will show you when there is something major happening in the market, right? You see that there is like a normal trading volume for the shares, right? When there is a major announcement like M&A, the volume spikes, right? You can see the spike in volume here, right? And turns out that this is the date that the market learned about. If you read the news, you'll see that actually is the date that the market learned about. The view is it's May 2014. Okay? So what happened to the stock price? It's clear there, right? Drop, right? It's not unexpected, right, that the stock price drops. The empirical evidence suggests a zero reaction. Plus, the other problem is they are issuing a lot of equity to finance this deal. And we know what happened. We learned in the morning what happens, right? When companies issue equity, the market tends to interpret that as a negative signal, so the stock price goes down. It's not a huge, it looks very big there because of the scale of the graph, right? But the price is going from 36.5% to 35.5%, right? The decrease is a few percentage points, right? But it's going up. Okay, so as I said, the CFO had better be conservative, right, when making assumptions, because the stock price is not going to jump, when an M&A deal is announced. Okay? Questions here? Everybody understand this? Okay? So summary of this mini case. The bottom line for what we're focused on is that AT&T issued stock, in this case, to mitigate the increase in leverage and to help maintain its credit rating. That's my summary of this case. And there is a negative stock price reaction, right? And if you want to get a little bit in the details, you might be asking yourself, right? Why did they issue equity if the stock price goes down? The CFO knows that, right? But if you go back to the trade-off model, right? The trade-off model also suggests that if you are over-levered, value is going to go down as well, right? Remember, it's 5%, the difference from 0 to 30, so you would lose a few percentage points in value if you become over-levered. And those two figures are not that big, they are comparable, okay? So in M&A, what we believe is that, this equity issuance, it's almost like a necessary evil, okay? The CFO would like to avoid that because they know that the market doesn't like it, but the other option may be even worse, right? Which is to have the company become over-levered, and that's why, we do observe a lot of equity issuance in M&A. It's one of the major exceptions, okay? Any question on this case? Necessary evil. Yeah. All right. So by the way, this is an SEO, okay? So this equity issues that a company does to finance M&A, that is an example of what we call SEOs, which is a secondary equity offering. That's when a public company like AT&T sells new shares to investors. The only technical difference in M&A is that you're not selling the shares for cash, right? You are exchanging the shares of the acquirer for the shares of the target. Okay? So the acquirer issues shares and then gives to the shareholders of the target, and the shareholder of the target gives the share. If you think of the share as a piece of paper, they just tear it apart, right? That share doesn't exist anymore. What you have in exchange is a share in the acquirer. Okay? But it is a secondary offering because it is a case in which a public company like AT&T with traded shares like AT&T sells new shares to investors. Okay, so that's technically is an SEO because it's, there is IPOs as well, and then, but this is technically an SEO. And as we learned already, as we discussed in the morning, the empirical evidence shows negative reaction to SEOs, right? So companies don't like to do SEOs on average. When you look at the aggregate data in the US, companies do a lot more repurchase than they issue equity. So there is a decrease, repurchases are bigger than equity for every year, except for years of financial crisis, right? Which is what we're going to see here. It's going to be one of our examples of this. Okay, so the question is, when does this happen? And I'm going to give you two examples that sort of maybe the two main reasons why companies would consider SEOs in the real world. One has to do with liquidity constraints, okay, and the other is I'm calling this a window of opportunity argument, but really what it is a situation in which the company shares are overvalued, okay, and then if your shares are overvalued, it may be beneficial to issue new shares because you're basically selling the shares at a price that is too high. Right, going back in the morning, right? If a company can sell shares at a price that is higher than the fair price, then you're creating value with the equity offering. Okay, so I'll show you what we think is a clear example of overvaluation in the U.S. market that you actually might have heard about. Anyway, the first one is liquidity, and COVID-19 is a very good example of a shock to liquidity in the U.S. economy. And in many parts of the world, I think had a similar effect. So, of course, what happened during COVID-19 is that many businesses closed down, right? And they couldn't operate normally. There were also problems with supply chain. So, there were, as this Wall Street Journal article is summarizing here, in 2020, companies raised a record amount of shares. Okay, and right. So why would a company? Why would it make sense to issue shares during a crisis? I think you can kind of rest the intuition even before I show you the case, right? Why would a crisis be a situation in which you would observe equity?
Price decrease anyway.
Yeah, maybe because the price is low. Yeah, that could be, the price is low anyway, and by that point you don't care. Yeah, right. Okay, what else? What's the benefit of issuing equity? Cash, right? And a time of crisis may be a situation in which, having the benefit of having extra cash outweighs the potential cost of having to issue equity. And our case, I think, is actually going to show some evidence that may be consistent with this story. Okay? So it's the liquidity story, right? And the example I like to do here is an example of a company that was very heavily affected by COVID-19. Not surprisingly, because this is a restaurant. If you are in US, you would know it. It's a steakhouse that focuses on high-end steak. So, and mostly indoor business. They really don't have anything outdoors. So when COVID-19 hit, they had to close everything, right? And this is a company that sells high-end. You're not gonna do high-end steak by takeout, right? That doesn't make much sense. It's kind of an event kind of place. So they were really hit very hard with the financial crisis. This is a chain. It's a U.S. chain. I think this restaurant is in Charlotte, North Carolina. This specific one, but there's most major cities in the U.S. have a Ruth Street Steakhouse. So this is some data on the profit forecast, and you can clearly see the impact of COVID-19 on the profitability of a restaurant. So the company's EBITDA in 2020 was close to $75 million. So they were fairly profitable, right? 2020, the EBITDA went down to less than $9 million. So they basically lost all the profits for that year. And then, of course, as we know, COVID-19, actually, we know it now, But one of the most interesting things is that financial analysts actually got the pandemic very well because they were already forecasting that the business was going to bounce back up in 2021, which is what happened. If you look at the actual data, the restaurants are open again and Ruth's Chris is doing well. But the analysts had that forecast in April of 2020, so financial analysts, maybe they were overly optimistic, but they seem to got it right. So here you have a situation in which you have low profits today. I mean, you have a negative profitability shock, but profits are going back up in the future. So you don't really have, it's not really a major business problem, right? Your business is fine. You just have like a very bad year because of the consequences of the pandemic, right? So, and then the problem, of course, the business is fine, the business is sound. The problem is companies have bills to pay, right? And in this case, we can actually calculate, we can look at the balance sheet, you can calculate how much like short-term liabilities they have. I don't think I'm showing the balance sheet on these notes, but I'll show you, we're also going to do we're also going to look at this company to talk about credit lines when we do liquidity management. But they had $60 million in short-term liabilities, including debt that was coming due, mostly accounts payable. Okay? They had accounts to pay in 2020, and it's a lot more, right, than what their profits are. Okay? So they expected profits to go to almost zero. They have to come up with $60 million. They only had $5 million. If you look at the balance sheet at the beginning of 2020, this company only had $5 million in cash. So if they don't raise cash, they go bankrupt. And it's not a very smart financial decision because this is a financially sound business, right? The analysts expect things to go back, to rebound. It's a strong restaurant, right? So it's the job of the CFO, right, to try to figure out what to do. So, and it turns out that Ruth's Chris did issue debt and equity. So the first bullet point is going to be one of, we're going to talk about this again when we talk about liquidity management during COVID-19, because it has to do with credit lines. So what U.S. companies did during COVID-19 is they used their credit lines to raise cash. It's very clear in the data, and it's a good example of why credit lines are an important insurance, have an insurance role for a company. But they had used it up. So Ruth's Chris used it up everything they had. So it's like maxing out your credit card, right? I don't know if that's not a problem in Europe as much as in the US, but people just max out their credit cards and they don't have anything else, right? And it turns out that Ruth's Chris did not have access to government funding. The US government had many programs to allow companies to issue, to help the bond market, etc. But Ruth's Chris doesn't have access, they didn't borrow in the bond market already, it was mostly bank financed. And the leverage was too high to qualify for the government program. So it basically had no government help. Okay? So what happened in this case is that equity became the best source of funding for the company during 2020. Okay, so they needed more funding other than the credit line, and what they did is they decided to issue equity. Okay, so this is an example of a situation in which the equity issuance is driven by this liquidity constraint. Okay, so you can see here the company's cash flow statement. You can see the long-term debt that was issued in March. That's right after COVID. That's what we're going to see when we talk about liquidity management. It's a very sharp, clear, right in March when the economy closed because of the pandemic, companies ran to the bank and drawn the credit line. Okay? So you can see here in the data, it's the cash flow statement for March, the end of March. You can see the $85 million debt issuance there. Okay? But then in the summer, in June, Ruth's Chris decided to do a secondary equity offering and raise an additional $50 million. Right? It also cut, right? It also cut dividend, it also cut dividends to zero, right? All the usual tricks, right? When companies have liquidity constraint, they're not going to be paying dividends, right? You can see it there as well. There's no dividend, okay? But we'll talk more about that on payout. So this is the SEO and the cash flow statement. Let's look at how it looks like in the in the actual SEO. We can get data on what the issuance actually looks like. So here is some numbers. So you have the number of shares that the company sold as a percentage of outstanding shares. This number I actually did, I think it's more like 20% according to my calculations, but anyway, that doesn't matter. You have the amount, the proceeds here, it's 43.5 million, but then there was an over allotment, meaning that there was a lot of interest actually in the share issuance. So, people were able to, the company was able to issue more shares than what was initially scheduled. So they ended up issuing 6.4 million shares, and then they raised about $50 million with the share issuance. Okay. And one important thing that we're going to focus on is that an equity issuance. You can see here in the data. Okay. When companies issue equity, when they sell equity, they have to set the price. Right? You don't sell equity at a market price. You're going to sell equity. The process of issuing equity requires companies to set a price. Okay? And this is actually turns out to be one of the main frictions and where we can see the cost of issuing equity. And we're going to show you in a second. Right? But these shares were issued at $7.75. Okay? And it's 20%, right? The number of shares issued corresponds to close to 20% of the existing shares outstanding. Okay, so it's a very large, significant SEO. Okay, so let's talk a little bit about the mechanics, how the SEO happens. So the Roof's Chris is an example of a type of SEO that is most common in the US, which is called the firm commitment. Okay. What a firm commitment or equity offering is you have an investment bank that essentially is the buyer. So the company doesn't go and sell shares in the market. The company sells shares to the investment bank, and then the investment bank places shares with the bank's clients and etc. and finds buyers. Okay, so the investment bank intermediates the equity offering. In the case of Roof's Chris, it was Jefferies LLC was the investment bank who was managing this deal. And like I said, this deal is done at a fixed price, so Jefferies is buying the shares of Roof's Chris at that price, basically. Okay? And then placing them in the market. So that's how an SEO is structured. Right? And now let's think about the investment bank perspective. Right? So suppose you are the manager of this. This is such a big deal that probably the CEO is involved in this. So suppose you're the CEO of Jefferies, right? And you're organizing this deal, okay? And you have to price it. We have to set a price for this, right? And the company is selling 20% of its shares outstanding, right? How are you going to price this? How is the CEO going to set a price? This is a public company, right? So how should Jeffrey set this price? Should you sell shares at the market price? Should you buy shares at the market price? No, right? Okay? So everybody understands that the investment bank is concerned that once the market learns about the share issuance, what's going to happen? Price drops, right? So the investment bank has to anticipate this, right? Somehow. And you have to, typically what happens in SEOs is the negotiated price is already significantly lower the market price. Okay? So the investment bank has to anticipate the fact that the shares are going to decrease, right? If the share price was not going to decrease, then the bank could buy it at the market price and then you can even keep it or sell it slowly, right? But the investment bank knows that there's probably going to be a negative reaction. So you can see in an SEO deal, you can already see the impact of the SEO on the stock price. And here it's very clear, okay? If you get data on the stock price, again this is stock price and the volume, and in this case, there is the I wish there was a bigger jump in volume there. It makes me a little bit suspicious. I was talking about the volume, right? This is the volume of trading. It doesn't really look that abnormal on that day. So, I'm a bit worried that there is already some anticipation of this issuance because, you typically see a big jump in volume when there's such a big event happening, right? But that's when the market, that's the filing date, that's when the market learned about the offering, right? And you can see two things here. You can see that the stock price of Ruth's Chris at the time of the filing was $9.50. It wasn't 7.75. However, right, once the offering is announced, what happened? The stock price drops to 7.5. Right? So the stock price is dropping to about the value that they negotiated in the offer. And then you might think, okay, but maybe they made a mistake. They could have tried to sell at a higher price. But then the problem is the price might drop anyway, and then the investment bank is going to pocket a loss, right? So this thing has to be negotiated among the parties. And then of course, once you agree, think about it. Once the company agrees to sell shares at 7.75, then the market is going to take that as a negative signal. Right? It's a signal that the company is willing to sell at this price. Maybe that should be the price, right? And the price does drop to that. Okay? And then of course there is a rebound after that. We'll talk about the rebound in a second, but right? Let's talk about right? I wanna use this. Any questions so far, by the way? And I'm just talking. Any question on this? Yes.
How do investment bankers calculate how much the stock price decrease?
I don't know. This is well, a good benchmark is the 3% number, right? But that's for an average. Remember that for an average SEO, the stock price decrease is 3%. However, the average SEO does not involve like selling 20% of the shares. That's a very large SEO. So the investment bank was probably being more aggressive in pricing this, right? And the company was okay with it, right? And then the question is, why was the company okay with it? And I think the reason is because they really needed the liquidity, right? So at this case, it becomes kind of a necessary evil again, right? But yeah, this is how they exactly come up with that number is a little tricky because you can't. It's the same problem that we talked about M&A, right? You have to negotiate this before you announce it, right? You wish you could announce it and then get the market reaction and use that, but you can't. So all you can do is use historical data, right? So you can look at similar cases and and then do some risk management. Well, see how much risk you're willing to bear, right? And then negotiate with the company, right? Of course, for the investment bank, if they manage to buy the shares at a lower price, it might be good for them. Right? Then it depends on what the company is willing to do. In this case, Ruth's Chris was willing to sell it at the discount. Right? And then that's the last thing we're going to do today. Okay, I know we're almost out of time. Let's go back to the dilution argument. Okay. So, we talked early in the morning, people talk about dilution, right? Oh, stock prices go down because of dilution. So here you could be trying this argument, right? If they issue 20%, the number of shares increases by 20%, there is dilution, the stock price should go down. The cool thing is we can actually check this because dilution is this mechanical story, right? That the stock price goes down because the number of shares increase. So in here we have all the data to do the calculation. So the old stock price, let's call the old here is the pre-announcement was 9.5. Okay. So what we can do as we did in the morning is we can calculate what should the new stock price be if the company issues equity at 7.75, right? So using the numbers from the equity issuance, right? The amount of cash that they are raising is 43.5, right? And and then they are issuing $5.6 million new shares, right? Just like we did in the morning. Okay. In this case, as we talked about in the morning, the stock price is dropping, right? Because you're issuing shares at a price that is lower than the market price, right? So remember, it is zero only if you issue shares in the market price. Here you're issuing at a price that is lower than the market price. But the interesting thing in the math is that the mechanical drop in stock prices is to 9.2. The stock price doesn't go to 7.75. If it's just mechanical dilution, the stock price would go to 9.2. Okay? But as we know, the price dropped to 7.75. It dropped a lot more than what the mechanical dilution argument would suggest. Okay? So here's how I like to think about it. If you're a naive analyst, you might say that, oh, this is easy to explain, right? Ruth Chris is issuing shares. There is dilution, so because there is dilution, the stock price should be lower, but if you do the math, you actually figure out that in this case, no, that doesn't explain the story because it should go to 9.2. There is a better way to think about dilution, which is the following graph. That's how I think about dilution. Okay? It's not that issuing shares is causing dilution and that's causing the stock price to go down. It's actually the other way around. Okay? It's the fact that the price is lower, right, that is causing the dilution. So the company, to be able to issue shares, Ruth Chris had to agree to lower the price. Right? It's not because there's more shares outstanding, it's just because that's the price you need to get to issue those shares. Okay? And then because the stock price is lower, then there is real dilution. Yes, you're issuing shares that are less than what it should be worth. So yes, your existing shareholders are being diluted, but the causality is not from dilution to the price, it's from the price to dilution. It's because you're issuing shares at a lower price that you're diluting your shareholders. Right? And we know that the market responds, or the investment bank prices the shares at a lower price, right? Much lower than what the mechanical dilution argument would predict. Okay? So, SEOs are, in fact, there is in fact a decrease in stock price, but it's not explained simply by an increase in the number of shareholders. Okay? So, just a final thing here, of course, if you look at this graph, let's finish this quickly because then tomorrow we can start from the other case. So you can see here though that the stock price reacted very quickly in this case. Yeah? So there was a decline, right, to 7.75, but by the end of May it was back up to 9.5. Okay? So if you read about this case, what people are talking about is that now there is the benefit of liquidity, right? So at first the market reacted to the issuance at a lower price, but then the market realized that maybe it's good news that Ruth Chris has all this cash coming in. They have good business and this is going to help them survive, and the stock price bounces back up, right? So in the end, you really didn't have the you really didn't have such. In the long term, even the existing shareholders didn't lose that much because the stock price, the price of their shares went back up despite the fact that they issued new shares. Okay? Anyway, any question on this to end the day? Then tomorrow we can start from the window of opportunity SEO. That will be a good place to start our lecture in the morning. Hopefully I'll be more awake. And thank you. Any final questions? All right, great. I'll see you tomorrow.